Good day, guys. Welcome back to another lesson. So in this lesson, we're gonna be looking at the Forex terms, right? So this is where we're gonna be breaking down a currency pair. What is a currency pair, and um what does the currency pair in the right stand for, the one in the left, the difference between the two, and stuff like that, right? So we are currently looking at Euro USD, right? So remember, Euro USD is a major pair, right? So we're currently looking at a Euro USD. So Forex currency symbols show two currencies and these come in pairs. For example, Euro USD. So as I showed you guys in the previous video, all of the currency pairs that we're going to be trading, they come in a pair. So you can't trade only dollar, the US dollar only. You can't trade only the euro only. It has to be in a pair, right? So the first currency is called the base. Let me just quickly get my annotation there so that we can. Okay, there we go. So the first currency, which is the euro, is called the base, right? So that's the base currency, right? And then, sorry, the second currency, which is this one here, is called the quote, right? That's the quote currency, right? So what does this mean, right? So this means that 1 euro, let me get my text. So this means that 1 euro cost 1 euro equals this amount of dollar, right? I hope I'm making sense, but let me just quickly go more deeper into this. So in this example, right, looking at the right here, looking at this price here, right? This price tells us that 1 euro cost 1.0662 dollars. So in order for us to get 1 euro, with my pros, yeah. So in order for us to get 1 euro, so that means we need to pay how much? 1.066 and something like that dollars, right? So this goes back to the example that I was showing you guys on the first video where I said what is Forex, where I was showing you how you can make money in Forex, right? So these are the same examples. So when you go to the booth, to the Forex exchange booth, or when you go to the bank, the banks are going to look at the currency pair that you want to exchange, want to buy or sell. For example, the USD, right? When you go to the bank, they will look at the USD and see the exchange price, and then they will convert based on that, right? But then now, let's say in this example, we look at the Euro USD, and then we have the Euro as the base currency, and then we have the USD dollar as the code currency, meaning that the amount that you see on the screen when you open this chart, right, is calculated in dollars because that's the code of that currency pair, right? So things now are gonna get a little bit juicy. Things now are gonna get juicier. Now let's do this. Let's do this example again, right? So the euro is the base currency and the dollar is the code currency, right? So on a chart, the market moves like this. And then this is how the charts look like. We have your y-axis and your x-axis, right? And then you will find that here you have dollar 1.00 1 point um, then we have, let's say, 0 0.80, and then let's say we have 70 here, and then I will just move this down around here. There you go. So this is the chart. This is the Euro USD chart. Let me just quickly also add this one here. I want you guys to follow with me. USD. So this is the Euro USD chart, right? So now the market is going to the upside, right? It's pushing to the upside. So what is this telling us? This is telling us, so let me just quickly add here. Code. Choose USD. I'm gonna show you this guys on the charts on the other videos. But for now, I want you guys to understand. So this is the Euro USD chart, right? So the market is going up, right? And then on the right hand side, we have our quote price, right? So when the market was here, this told us that, okay, cool. Now we can buy €1 at this price, right? So this is how much €1 was going to cost, right? €1 was going to cost how much? 70 cent dollars, right? Equals €1. Right. Same example here. So when the market went up and then came back, and then when we get to the market, this was the area where price was at, which was at 80 cents per euro. So meaning that €1 cost how much? 80 cents, right? 80 cents dollars. This is the code of the of this chart. This is the code of um of this currency pair, right? So this is the code price, right? So the code price is what is in dollars because the dollar is the code currency, right? So let me just recap this again. So this is the code price in dollars because the dollar is the code currency in this currency pair, right? In this currency pair, the code currency is the dollar. So if the currency pair was USD, if it was other way around, euro, then this was going to be in euros. So meaning that 80 cent euros would have bought us $1, and then sorry, 70 cent, and then 80 cent euros would have bought us $1 if this currency pair was like this, USD euro. But now the currency pair is like this, which is euro USD, meaning that the code price is going to be in dollars because the dollar is the code currency, right? And then the euro is the base currency, meaning that in this currency pair, we are buying the euro using the dollar, right? So whatever price we are going to see on the screen is going to be in dollars because the dollar is the code currency and the euro is the base currency, right? So this is how you can identify which currency is the code, which currency is the base, right? So whatever is on the right is the base. Whatever was on the left, sorry, wait. Confuse myself here. So whatever is on the left, yeah, is the base, and then whatever is on the right is the code, right? So you can just like maybe throw this like somewhere, make notes, and then just write the euro, then you put a slash USD, and then you just make notes, code base, and then you make an example here. In this currency pair, the price we see on the chart is in dollars, you know. So this tells us that if the price is at this area, this tells us that, okay, cool. 1 euro currently costs 80 dollars. And then you can just make those notes there. So this is how you can identify the two. This is how you differentiate here between the two. So the one on the left is the base, the one on the right is the code, right? So when you open your chart, whatever you're going to be seeing on the right is going to be the code price. So if you're going to be trading Euro USD and then you open your chart, the price that's going to be on the right hand side is the code code price, which is going to be in dollars. If you're going to be trading USD ZAR, right? So that means on your USD ZAR slash ZAR. So that means on your right here, the code price is going to be in rands because the rands is the code price, right? So if you're going to be trading GBP USD, the British pound against the dollar GBP, so this means that in this chart, when you open it, the price that you're going to be seeing on the right hand side is what is going to be in dollars because the dollar is the code price in each and every pair, right? Let me just go quickly back, show you here. So in this example, the dollar is the code, the Japanese yen is the code, the dollar is the code, the chef is the code, the CAD is the code, the dollar is the code, the dollar is the code, pound is the code, the yen is the code, the CAD is the code, the chef is the code, and so on, right? So let's go back. So this is how these are the this is how you differentiate between the two currencies, and then this is what each currency mean when it goes to the chart, right? So just know that the one on the left is the base and the one on the right is the code. Okay, now let's move to the next term. Don't worry guys, this will make sense as we go along, right? Just make sure that you make notes and then you rewatch the videos to understand and ask questions if you don't understand anything. So pips, what is pips, right? A pip is a short name for point in percentage. It represents a tiny measure of the change in a currency pair. Remember, now we're talking about currency pair. So when we talk about currency pair, we're talking about Euro USD, right? Not only Euro, but Euro USD, right? It has to have two currencies, right? So currency pair, it represents the tiny measure of the change in a currency pair in the Forex market, right? Remember on the first slide where I was explaining what is Forex and how you can make money in Forex, right? The changes in interest rates. Now, the changes in exchange rates allows you to make profit and allows you to make money, right? So those changes are calculated in pips, right? So when the dollar moves from 11 Rand to 15, sorry, I'm lazy to type, 15 rands, this means the difference between 11 and 15 is gonna be the amount of pips this currency pair moved, right? So this help us determine how much we're targeting and how much we are willing to lose in the market, right? So this is how I can explain pips, but I'm going to also show you in the market how you can calculate the pips in the charts, right? It can be measured in terms of code or in terms of the underlying currency, right? As I explained, for example, underlying currency, which is the rand. So we came from 11 rand to 15 rand. So we can calculate the difference between the two. For example, it's going to be 4 rand. But then if you calculate in pips, you're also going to get an amount of how many pips the currency changed, like moved. A pip is a standardized unit and is the smallest amount by which a currency code can change, right? So in the market, the market moves, the currency pair moves in it can move 100 pips, but then in the real world, that 100 pips didn't make a lot of changes in the market, right? So for example, where's my mouse? Oh yeah, there. For example, Euro USD, let's say it moved 100 pips today, right? And then the opening price was 1.60006. But then when the market closed, the price was at 1.00067, right? So when the people in the news like tell us how much the money has changed in today, like the current what is this, the exchange price change, right? You will see that there's not a major change. Maybe it changes in cents, but then in cent or cents, yeah. But then when you go to the chart as traders, you notice that it moved 100 pips. But then when you check the actual difference in the money, you will see that, okay, cool, you only move like 1 cent or 2 cents today. So there's no major movement, So that's why I said, if you're gonna be investing through the bank, that needs to be a long-term thing, because in a day you can make a change of $1 or 20 cent dollars or 20 cents dollars or 50 cents. You understand? So depending on how on the movement on the market, and there needs to be something major happening for the currency to just like change to that big amount, just like that, right? So what is pips? A pip is a short for point in percentage. It represents a tiny measure of change in the market. With my error, a change in the market, like in a currency pair. It can be measured in terms of a code or in terms of the underlying currency, right? So depending on how you're looking at it, you can see from the difference in price, okay, cool, we were in 11 rand and now we're 15 rand. So now you can know that, okay, cool, this price, it might have moved a lot of pips, but now we are going to be focusing on pips because we are going to be day trading, right? So we're not looking at how much the dollar changes in today. We just want that specific movement to make money using pips, right? So this is what the pip is, right? And then in this example here on the left, as I made an example here, for example, this one here, right? So if you look at this one here, right? So price moved from 1.0665 to 1.0062662. Yeah. And then the difference between that movement is 3 pips, right? So with this 3 pips, depending on how you trade, you can make a lot or you can make a little, depending on the trading plan, right? But that's something that you guys are going to learn as we go along, right? So currency pair, the movement that it made in a day, is calculated in pips. In weeks, same thing, right? As we trade, right? So a pip, just to recap, a pip is a short for point in percentage, right? It represents the change in the movement of a currency pair, right? So that's it on a pip. And then let's move on to the next one. Remember, if you have questions, you are welcome to send us a DM. Okay, and let's move on. Lot size. So this works in hand with what I just explained now, which is the pip, right? Let's move this aside. So a lot size, for example, a lot size is commonly traded in a specific Forex is commonly traded in specific amounts called lots, right? So these are basically the number of units that you're gonna buy or sell a currency, right? So these are number of units of currency that you're going to buy or sell, right? So the lot size that you're trading with has a direct impact on how much a move in the market affects your trading account. The bigger the lot size, the bigger the profits you get, but then also the bigger the lot size, the bigger the losses you're going to get. Therefore, you trade the volume has an effect on your trading strategy and your management of risk, which is something that we're going to teach you how to calculate your risk and how to know how much to lose based on pips and locating at the account. So let me just quickly cancel this. So a pip measures the change in a currency pair, right? And then from this price to this price, we moved 3 pips, right? So now a lot size is an amount of units that you're going to buy from a currency pair, right? There's a nano, there's a micro, there's a mini, there's a standard. They all move in different ways. A nano means that 1 pip costs 1 cent. A micro means that 1 pip costs 10 cents. A mini, let me just get my annotation arrow there. Let's change the color to red. So a nano means that 1 lot, 1 pip costs 1 cent. And then a micro means that 1 pip costs 10 cents. A mini, that means 1 pip costs $1. Have you guys now can start seeing the difference? A standard means that 1 pip costs $10. So if Euro USD moved 3 pips and you use a nano, I'm gonna get to more into details in the risk management video regarding this. So I'm just gonna make an example using let's use the mini lot size. Mini lot size. And then this means so that if the mini lot size one movement per pip cost $1, and then we moved 3 pips. So that means if we use a mini lot, that means it's either you made $3 or you lost $3, right? Why am I saying that it's either you made or lost $3, right? So 3 pips, one cost $1, so that means there's a $3 in stake, right? So if you bought and the market went down 3 pips, that means you are negative $3. But then if you sold and the market went down, then you are up by $3 in positive, right? So that means you're in profit of $3. But then if you bought and the market went up and then it moved 3 pips down, and then if you sold and then it moved 3 pips down, that means you are on a negative 3 pip, which is negative $3 in your account. But then if you sold and then it went down, and then, oh yeah, if you sold and then it went down and then it moved 3 pip, that means you are up by $3 in your account, which means you're in profit of $3. But then if you bought, but then the market went down and then it went minus 3 pip from where you bought. So that means in your account, you are negative $3 by just looking at the lot size you used and the amount of pips the currency pair moved, right? So let me just quickly recap this. So the lot size is the number of units of the currency pair that you will be buying or selling, right? The bigger the lot size, the bigger the profits, but also the bigger the losses. Therefore, your trade volume has an effect on your trading strategy and your risk management, meaning that you need to make sure that you are trading the right strategy, which is what we are going to teach you, which is right. And then the risk management needs to be on point, which is also something that we are going to teach you, right? So by knowing that a currency pair movement is measured in pips, and then now you know that if you can use a different lot size, you can get a specific amount of money depending on the lot size you use. And then you bought the market here, and then price went down minus 3 pips. You already know by now, if you use a mini lot, that 1 pip cost $1, and then we are down by 3 pips. That means I'm down by $3, right? And then if the market goes down and then you sold and then it's down by 3 pips, that means you are up by 3 pips in your profit in your account, right? Because 1 pip cost how much? $1, right? So this is what a lot size is, and then this is how you can use it, right? And as you guys you can see now, it also like work in hand with what I've been like showing you guys in the previous slides and previous videos, right? So now let's move on to the next one. Remember, rewatch these videos, and if you have questions, you can just like put me a message or one of the mentors. Okay, so now we are looking at bid price and ask price. What is a bid price? What is the ask price, right? We are still in a currency pair. Remember that you need to first understand what is a currency pair and how the currency pair, how you can differentiate between the two currency in a pair. What is a bid? What is a code? What is a base? You know the movement of the currency is calculated in pips. You know that in order to make money, your currency pair, you need to use a different lot size based on the risk management on your account, right? So now we are going to look at the bid and ask price and the spread, right? So the bid price is the price that the bank buys at, and the ask price is the price that the bank sells at, right? So when you go, I think I did explain this on the brokers video, right? So when you go to a bank to buy the dollars, right? The bank, so when you go to buy at the bank, let's quickly underline this, and then the ask price is what the banks sell it. So when you go to buy at the bank, right? This is the price that you're going to buy it. Wait, yeah, the bid price, the bank that buys it, yeah. So when you go to buy at the bank, this is the price that you're going to buy it, right? And then when you're going to sell, this is the price you want to sell it, right? And then the difference between the two is called a spread, right? And then how does the broker make money? They make money through a spread, right? So the difference is what goes to them so that you can able to use their platforms, right? So this is that's why I said I'm going to explain this to you when we go to the other videos. Yes. So a bid price is the price that you buy it or the banks buy it, and then the ask price is the price which you sell it or the bank buys it. Sorry, the bank sells it. Yeah. So in Forex, if you want to buy a currency pair, you will get the ask price, and if you want to sell a currency pair, you will get the bid price. The bid price is always less than the ask. Right. So let's continue with this one. Wait, there we go. Yeah. So this is the bid price. You will always find the bid price higher, and then you will always find the ask price lower, right? And then whatever is between these two lines is called the spread. So when you open a trade, let's say the price is moving here. So when price is around here, so when the market is around here and then you buy, right? So what the broker is going to do is going to look at the bid price at that time, and then that's where you are going to buy, right? Which is around here. But then if you were looking to sell at this where the market is currently at, then the broker was going to open your trade at this ask price, right? So this is the price we're going to sell at. So this is the bid price which you buy at. So you buy here, and then the moment you open a trade, you're going to be in the minus. So the reason you're in the minus is because now you're paying the broker the spread. No, so you can't buy and be in profit. There are going to be times where you're going to buy, and then the market just moves to your direction same time, and then you're going to be in profit. All right. But then the moment you open your trade, that's why you're going to see that you open, you're in a loss same time. You're in a negative. Is because first, your price is at a high price than the actual price, right? Because this is the price, this is the bid price of the broker, which you're going to buy at. And then this is the ask price of the broker, which you are going to sell at if you decide to sell the market, even though price is currently floating around here, right? What the broker is showing you, that is their buy price, and what is their sell price. Those are the prices that you are going to use, right? So the moment you open a trade, if this is the current bid price and you buy, this is where your trade is going to be opened at. If you're going to sell and then the ask price is at this price, this is where your trade is going to be open at, right? So let's continue. Okay, I didn't mention the spread. So the difference between the bid and ask price here is the spread. So in this example here, the difference between this is the bid and this is the ask price. So the difference between the two is 3 pips. So meaning that the moment you open a trade, you are gonna be minus 3 pips, right? So the spread in this broker is currently at 3 pips. Why are they showing it in pips? Is because the amount of units which is the lot size, which we just talk about, is gonna be affected. This is going to affect, the lot size that you're going to open at, this is going to affect your account when you open the trade, right? So if you open at a mini lot size, which costs $1 per pip, and then the spread is 3 pips, this means you are going to be in a negative $3 the moment you open the trade because of the lot size you are using, right? If you use the nano, which is going to be, I think it's 1 cent per, 1 cent per pip, that means the moment you open a trade and the spread is 3 pips, that means you're going to be in a negative 3 cents. But then if you open a micro, which is about 10 cents per pip, and then the spread is 3 pips, that means you are going to be in a negative 30 cents when you open a trade because of the spread, right? Depending on which direction you're going. So a broker with a higher spread, it's a no-no, right? Because imagine having a 10 pip spread and then 1 pip cost $1 when you're using a mini lot size. That means you're gonna be like in a minus $10 by just opening the trade, right? So at least the spread has to be lower. And so yeah, I did mention the bid price. So just to recap, the bid price is the price which you buy at, and the ask price is the price which you sell at, right? And then the difference between the two is called a spread, right? So always make sure that you check the spread of the broker you're using so that you can know which broker to go with. And then also the reason I did explain the exotics and the major was to show you that the exotic have huge spread. So imagine opening a micro lot size on sorry, a mini lot size on a USD ZAR, and which it has about plus minus 10 to 15 pip of spread. So so this means the moment you open a trade, you're gonna be negative $15 because now the spread is 15 pips, and then if you're using a mini lot size, which is gonna be $1 per pip, so that means 15 pip times by $1, that's $15. So you're gonna be in a negative $15 when you open on an exotic pair. So that's why we always say focus on the major pairs because they have low spread. At least a 2 to 3 pip spread, we can deal with that, right? But then a 15 pip spread is too much. So please make sure that you pay attention to that. So that's it for the slide. If you have questions, again, make sure that you DM us. And then if you don't understand anything, just make sure you ask us, right? Please rewatch the videos until you understand, guys. Okay, let's move on to the next one. Okay. What is take profit and what is the stop loss? So when you enter a trade, right? This is something I'm also going to explain in the risk management, but I just want you guys to understand what is a stop loss and what is a take profit. So when you enter a trade, you need to have a target, which is take profit. When you enter a trade, you need to have a risk allocated, which is a stop loss, right? Where on whatever investment you're doing in life besides trading, you need to know how much you are risking, right? You need to know how much you are risking. You can't just spend invest in something not knowing how much you're gonna be losing, right? So you need to make sure that you know how much you are losing. So which means it's a stop loss. A trade that you open needs to have a stop loss, right? What is a stop loss? A stop loss is an amount of money that you are willing to lose on the trade, right? A take profit is the amount of money that you are looking to target, right? And then take profit, which is something that leads people to greed. We're not just going to target any random amounts of money on the market because the market is not controlled by us. And then there's a high chance that price can change direction at any time and then move, right? So that's why you always need to have a stop loss so that you can protect your capital, right? So a stop loss is a amount of money that you're willing to lose, and then a take profit is the amount of money that you're going to be targeting. So that's the simplest way how to explain it, right? So let's move on. So what is a buy limit? These are orders, right? So when in the market we have orders. So we have 3 orders. We have execution, like market execution. This is where you open a trade manually and say buy now or sell now, and then your trade goes into the market same time, right? And then we have limit orders and buy stop orders, right? So a stop order is placed above the price and the price keeps going up, right? So that's something that I'm going to explain, but I just want you guys to know that stop orders are always put in front of the price, right? And then limit orders are always put behind the price, right? So when you want to put a a buy stop, if the price is here at this blue circle, this is where you put your buy stop, so that when price goes up, it triggers you into a trade and then it moves to a direction. If you want to put a sell stop, this is where the market is currently at, right? And then this is where you are allowed to put your sell stop, and then the market is going to move your direction, right? Buy limit. So this is where the price is currently at, but then we're anticipating that the market must come down and then take us at this limit price, and then we move the direction, right? So the difference is that on a stop order, the price has to be in front of the price, right? And the buy limit, the price has to be behind the market price, right? So in this area, price comes back. So yeah, so let's say we're selling here. You want to put a sell limit. So what the sell limit does is the price goes back up, and this is where you're gonna put your sell limit, right? And then the price goes down. So that's how it works. Simple as that. Sell orders, sell limit orders. Limit orders are always put behind the price, right? Stop orders are always put in front of the price. This is the simplest way you can explain it, and I'm going to show you guys the examples in another video. So let's move on. So risk management, right? Risk management is key to success when it comes to trading. With poor risk management, 70% of the time you will lose your funds. In order to see the results you're expecting, you need to apply proper risk management on any trade that you take. So that's why I say that don't enter a trade without a stop loss. You need to know how much you're losing, you're risking before you enter an investment, right? So take trading as an investment, right? It's not a gambling. Take it as an investment. If you are going to open a trade without a stop loss, there's a high chance that you're going to lose all your money. There's a high chance that you're going to lose all your money. But then if you have a stop loss, at least you're going to be taken out, and then you being taken out gives you a chance to think again about re-entering the trade, and then to look at why you were taken out, right? But then if you don't have a stop loss, the market, if you buy and the market just keep going down, you are going to lose your capital, right? Let me just quickly throw an example. Let's say here, the market is moving up, and then you decide to sell here, and then there's no stop loss, right? So in this case, the stop loss has to be here because you're selling. You're expecting the market to go down, right? So this is why you have a stop loss around here. But now, what happened is the market just keep going up. Let me just do this. So you sold here, right? And then you entered, let's say, a mini lot size where where 1 pip costs $1. You enter here, you then have you have a $100 account, right? You entered here, no stop loss, and then the market just keep moving up, and the market moves about 100 pip. The moment even that market gets 200 pip, your account is already gone. But if you had a stop loss around here, let's say at 10 pip, you would have lost $10 and save your account, and then you have a balance of $90 to get another chance to enter. But then without a stop loss, and then you just decide to open a trade and let it run, and then the market keeps going up, you lose all your funds, and there's no way to get it back besides depositing more money and go to trade again, right? Always risk less to make more. Like a risk ratio of 1 to 1 is not worth it. My nose are blocked, sorry guys. So you can't be willing to risk $100 to make 100. I know some people do it, but be realistic, right? At least risk $100 to make $200. Risk $1 to make $2. Don't risk $1 to make $1, right? Risk $10 to make $20, right? your investments need to make sense when you look at your plan, right? When you look at your results, it needs to make sense, right? So don't try to chase your losses. Always take a break from the market after taking a loss or do something else. That's why I said in the mindset video, please make sure that you do something. Jog, like do something fun, you know, have a hobby, read books, audiobooks, um, just do something that's in line with what you want in your life. That way it will keep your mind focused, right? Don't do something that's not in line with what you want in life. Do something with with what is in line in life so that you can be able to focus, right? So if you take losses, go out, do something else that you love so that you can get you back in mind and then you can come back. Don't go out and do something that's going to stress you even more, right? If you read a book, it's going to calm you down and kind of like give you an idea of how to focus, and stuff like that. So yeah, let's move on to the next slide. I'm gonna be going on a full series of risk management where I'm gonna be going into detail on how to apply risk management and stuff like that so that you guys can understand all of this. Right. So now let's move to the next slide. So Forex psychology. I'm sure you've been hearing about Forex psychology everywhere out. So this is something that we can teach, right? We can't teach you, but we can guide you through trading, right? We can't teach you how not to be nervous. We can't teach you not to be overconfident. We can't teach you not to have fear. We can't teach you not to be greedy. We can't teach you not to have anxiety. We can't teach you not to have FOMO, not to have doubt. You understand? So these are the things that we can't teach you, but we can guide you through your trading career, right? And that by guiding you through your trading career and then looking at the mistakes that you have made, and then because greed lead you to taking certain actions, and then or a certain mistakes, a small mistake can lead you to being greedy, right? So our work is to analyze all the actions that you took, all the mistakes that you took, all the mistakes that you made, and then try to better that so that you can become a better trader, right? So that the next time you do that, you already know that, okay, cool. The last time I did this, it led me to greed and then I end up losing a lot of money. But now at least you can be able to minimize that. So that's something that we can teach you, but we can guide you. Right? And also all of this comes to discipline. You have to be disciplined and be accountable of your actions. So if you are not disciplined, you are not going to be able to be accountable. I hope I'm making sense there, you know. But yeah, so never allow fear to drive you away from your dream. Never allow fear to drive you away from your dreams, right? Fear is a liar. You grow as you risk. You grow as your risk grows. If the loss is going to hurt you, change the risk size. Which is the lot size. The amount of pips that you lose, you're risking. Everything is planned. So if you fear of losing certain amount of money, then reduce the lot size. So if you're doubting a trade, don't take it. Wait for another one. If there's greed, don't trade every day, because now that's going to lead you to greed. Have a target, have a plan. But that's something that we are going to be that's why we're going to be mentoring you guys. We're going to be there for you 24, not 20, is it 24, not 24, but 20 hours a day. We're going to be available, but we are going to have schedules. So please bear with us if we are not available, because what we want to do is we want to have each individual, we want to focus on one person at a time, right? So we don't want to put you guys in one Zoom call, and then because some of the people are shy, so a one-on-one will be better. Unless you feel comfortable being around other people, then we are going to have those, but we are going to have those Zoom sessions. So before I talk a lot, because I don't stop, so this is it for this video, and then I'm going to catch you guys on the next sessions. So after this one, you are going to do the quiz, and then the quiz is going to show us if you understand this section, and if you don't understand, don't stress about it. We are gonna go through it together, set up a one-on-one, and then just explain where you don't understand. And then once you pass the quiz, and then you move to the next section, which is gonna be risk management. So cheers guys, I hope you guys are enjoying the content, and you are studying. Make sure that you study and invest the time. Cheers.